Okay, so in this slide, I'm going to talk about the long-term statistics versus the short-term statistics. And what is considered to be a long-term statistics is that you are tracking the market at least for 1 to 2 years, and also you have over than 150 samples to support your theory. And beginners traders always focus on the short-term stock behavior. So, for example, in the current 1 or 2 month that let's say the biotech is really hot or energy sector is really hot, so they only focus on energy sector or biotech, and they only have maybe 3 to 4 samples, and they will judge the stock behavior based on that 3 to 4 samples from 2 weeks ago. So that is not very ideal because whenever you only have few samples and you're saying that the biotech is going up 1,000% and 2,000% in the last couple of days, and I want to find another biotech that could go up 1,000, 2,000%. But the only difference is different biotech has its own fundamental, their flow is different, their market cap's different. So the bigger the market cap, the more money it needs to be injected into the market cap for the stock to go up. So that has to take into considerations. So not all biotech sector stocks can go up 1,000%. And I see a lot of beginner trader making the same mistakes. They think that we had a few breakouts in the biotech sector, and I think the next one, biotech sector is going to break out. And what will end up, the result will be is they chase into the 3 to 4 biotechs, and then the pretty much after morning push, the stock crashes after forming a consolidation, and they lose all their money. So this is where short-term statistics do benefit you if you have a long-term statistics, and do not always, I would say, focus on the short term. Whenever you always want to focus on the bigger picture, and also pay attention to how's the short term statistics are going to benefit you from shorting them when people are getting used to buying biotech sector after 3 to 4 plays. So this is a good, I would say, psychology counter. Now you can use the beginner psychology to develop a strategy, to develop your counter strategy to the beginner traders, and that's where you can make a decent profit from. So I have been observing the market for a very long time, and it always happens whenever there is a hot sector and everybody tends to buy at the open after the 3 to 4 plays, either the short getting squeezed, then they will still be chasing, and the shorts will be a little bit too scared. That's where nobody's focused on the long-term statistics. This is where your edge can come from. Whenever there's no resistance, you can short into the fear of shorts are not going to get in. You also can short into the behavior, the constant behavior of people chasing after market open in a hot sector after 3 to 4 plays. So that's why I do not recommend all shorting into the first green day and the first hot sector after 3 to 4 months when there's no play. For that point, keep in mind. And also by observing short-term statistics is very helpful for adjusting your strategy, but it's not good to repeat them. So once you are observing the short-term statistics, and you can make that adjustment into your long-term statistics and look at the overall picture to see what has changed, what has not. Based on from my observations with the short-term statistics, majority of the time they do not change. The only time they change is whenever you don't see a play between 3 to 4 months, and all of a sudden there's 1 to 2 plays that go up 1,000%, 500%, then everybody is going to be in that ticker. That ticker is going to get really crowded because they haven't seen a ticker that's going to make them money, and this is the big potential for a very long time. And whenever you don't see a ticker for a long time, and you don't see an ideal ticker, and all of a sudden there's one popped up, everybody tends to sizing a lot bigger than usual. That's where they make the major mistakes. So you do not want to be that guy, and always avoid the very first play after a while, and always focus on the bigger picture. And for this specific mistakes, most traders do make the same mistakes whenever there's no play for 3 to 4 months. I would say everybody gets a little bit too eager, and the same thing happens to me as well. It happens to me in the last 7 years for many, many times, and I made way too many mistakes. So I would say that I want to put this one as your trading rule, that you want to write this down, that whenever you don't see ideal ticker between 2 to 3 months or 2 to 4 months, always avoid the first two major play that went up a couple 100%, because those are very dangerous to short and they do not follow the normal statistics. And it's going to be very crowded, too much volume, and you will see when the volume's getting too much, but most people stay in there anyways. And that's how they make the big mistakes and they have to use the next couple plays to make their money back. So by the end of the day, you will come out even. And I don't think it's really worth it. And it's much better to avoid the first one. And the last point is for you to be very sure with the long-term statistics, you will need at least more than 150 samples on a strategy before you start trading a pattern. And for pretty much all my strategies, I have around a couple hundred samples in one strategies in the last couple of years. If you do not have the samples, if you are starting to trade this year in 2022, 2023, and you say, hey, I do not have the 150 samples in the strategies, either you can join the Freeling Challenge, you can see all of the statistics or monthly report in the last couple of years, and you can plug that in. But when you are plugging the chart or other people's chart into your own statistics, always go back into that day. I would say either you want to replay the chart, or you want to either memorize the chart or look at them, I would say, every single day to print that in your head. And in that way, it's going to be an example that's in your head, and it's much better to say, hey, I want to trade this pattern. Let me go back, look at my statistics sheets. That's where it takes time. Second, when the samples, you are not really experienced by yourself, you don't have that confidence in your mind. So that'll be the major problem, that people take other people's statistics and they think is going to be helpful. The problem is, if you only see the result, it's not going to be helpful whenever you're trading, because the other people has the confidence since they tracked them one by one by themselves, and they have the confidence that built from the very bottom. But if you are taking the result of other people's spreadsheets, then you will not have that confidence. And there will be a significant difference when the trading result comes out for one that builds the spreadsheets from the very beginning, and the one took the result of that spreadsheets.